Hi, my name is Bob Irish. I'm your host for today's interview with Dr. Steve Sjuggarud. We're coming to you from Dr. Sjuggarud's 50-acre estate in northern Florida. Dr. Sjuggarud, thank you so much for being here. I know at this time of year, everybody's busy, so I know what you have to share with us today must be very important.
Thanks, Bob, and please call me Steve. It's true, so much in the world has changed since the beginning of 2020. And in many ways, the country has never been more divided. I can't remember a time that was more divided politically in my lifetime. And I think the same is true for most Americans' finances. Either you've never been better or you're really struggling. And in the stock market, as well as here at Stansberry Research, half of the analysts I follow are calling for an imminent crash in stocks, while the other half have never been more bullish. And as a partner in our business, I'm sure that's left many of our subscribers extremely confused. That's why I promise I'm not going to tell you to buy or sell a single stock today. I'm not going to talk to you about cryptocurrencies or bonds, and I'm not going to try to sell you one of my research services today. Instead, I'm here today to clear up any confusion. After you watch today's presentation, my goal is for you to know exactly what to do with your money. And regardless of what you've been doing with your money for the last few years, you're going to start 2022 with a customized plan for you. I know almost everyone is holding their breath right now, wondering what could set off the next big crash in stocks, or if it's already started. After all, just last month we saw how the newest variant of the virus, the Omicron variant, spooked the markets and led to several days of severe sell-offs. Since then, stocks have been seesawing back and forth. And it seems like every time we have a light at the end of the tunnel, as far as this virus is concerned, we see calls for new lockdowns. So it is clear that as far as your financial health goes, there's no guarantee that we're out of the woods yet. And that's why I'm here today. I have a very important announcement to make, something that could have a dramatic impact on the financial health of everyone watching right now. And not just my readers either. If you've never bought one of my recommendations, even if you don't subscribe to any of my work, as long as you have any money invested in stocks, I assure you that what I'm here to share with you could have a dramatic effect on your wealth.
Now, Steve, you obviously don't need any introduction for many people watching, but allow me to briefly introduce you for anyone tuning in who isn't as familiar with your work.
Sure, Bob, that sounds great.
If you don't know Dr. Steve Sjuggarud, he has an MBA and a PhD in finance. He's a former hedge fund manager, broker, mutual fund vice president, and has done pretty much everything there is to do in the financial markets. He's been quoted by the Wall Street Journal, Barron's, the Washington Post. He's appeared on Bloomberg and Fox Business News, and he has even helped ring the opening bell at the New York Stock Exchange 3 times and once more at the NASDAQ. But more importantly, Steve has accurately anticipated the biggest money-making opportunities of the last 2 decades, like gold in 2003, biotech in 2012, real estate in 2011, and Chinese stocks in 2016. He's also well known for predicting Dow 20,000, the dot-com crash, and the housing bubble in 2002. And of course, Steve is most famous today for calling the bottom of the financial panic and urging investors to buy stocks on March 20th, 2009, just 2 weeks after stocks had hit their ultimate bottom. Dr. Sjuggarud has been bullish ever since. If you bought stocks when he said so and held on until today, your portfolio could be up as much as 470%. And finally, in October of 2015, Steve debuted his now famous prediction for a melt-up in stocks in front of a small audience of our lifetime subscribers at a luxury casino in Las Vegas. His simple thesis was, interest rates will remain lower than you can imagine for longer than you can imagine. And that will cause asset prices like stocks and real estate to soar higher than you can imagine. At the time, many doubted the market could go higher, but of course we know today that it did. And his idea of a melt-up in stocks, ended up splashed across the front page of financial journals everywhere. Bloomberg, Forbes, MarketWatch, and the Wall Street Journal. In short, there's nobody on Wall Street, or anyone in the investment world for that matter, who did a better job calling the 11-year bull market more accurately. But Steve, then the black swan event of the century takes place. The COVID-19 pandemic squashed the 11-year bull market and led into the fastest bear market in history.
Yeah, Bob, COVID really was a true black swan. It didn't look like a global catastrophe at the time until it already was. Look, I have experienced a lot of major bear markets firsthand. I have seen many markets fall dramatically many times. But unlike the dot-com crash or the Great Recession, there were no fundamental cracks in our economy that led to this crash.
But you didn't panic, Steve. Not long after stocks began to fall, on March 6th, you wrote to your followers to say, as I write, the S&P 500 is down 13% from its all-time high. I want to limit my own losses and yours. Follow your trailing stops. Times are bad right now, but they won't be bad forever. I believe we will have a fantastic buying opportunity soon.
You know, I personally believed the drop in the market was going to be temporary, but the number one factor in my success as an investor over the last 25 years is that I follow the data, not just my instincts. And when the data told us to cut our losses short, that's exactly what we did.
And that turned out to be the right call. I mean, over the next 17 days, stocks fell another 25%. Before bottoming out. For readers with big retirement portfolios, that could have meant saving them from hundreds of thousands of dollars in additional losses. Then, on March 20th, exactly 3 days before the market bottomed, you were preparing to issue buys once again. You wrote, U.S. interest rates have hit record lows, and the government is seriously considering passing out checks to, well, everybody. In that same letter, you told your readers to scoop up shares of a little-known company you said would benefit from the chaos in the market. That company rose as high as 108% after your recommendation, and you've made a string of recommendations across your services to help your readers take advantage of the rebound since, like showing them 58% gains in 6 months on GRVY, 135% gains in 12 months on Xiaomi, 39% gains in just 6 months on ARK Fintech Innovation Fund, 87% gains in 7 months on Xinjiang Mining, 78% gains in just 6 months on Sjuggarud, and 237% gains in 9 months on Futu Holdings. Not to mention open gains right now as high as 86% in 18 months on a home construction play. 56% in 5 months on a commodity investment, 78% in 14 months on a banking play, 227% gains in 18 months on a tech recommendations, 105% in 17 months on a play on the S&P 500, 157% in 12 months on a semiconductor investment, and 85% in 14 months on another banking play. These results are simply incredible, Steve.
Now, Bob, the chance to act on these opportunities has passed, but I'm happy that it worked out for our readers. And my hope is that readers took advantage of those opportunities to make up for some of the losses they may have suffered when the market crashed in March of 2020. But the fact of the matter is that I never would have been able to get my readers out of stocks when I did, and then recommended all those huge winners when I did, if it wasn't for the secret that I'm going to share with you today.
Steve, you also told me you have something totally new to share, both a warning and a new prediction, something that I imagine must be pretty important for you to take time away from your family right now to film this message.
That's right, Bob. Stocks are up over 100% since the COVID crash. And it seems like every week indexes are hitting new all-time highs. The Dow recently cracked 35,000, the S&P 500 hit 4,600, and the NASDAQ hit 15,700. So in short, we are in the middle of the melt-up that I've predicted for years. The COVID-19 crisis sidetracked it just temporarily, but it didn't stop it. Now that we're enjoying the big gains that I always said would happen during a melt-up, it's time to plan for what will come next. That's one of the reasons I'm here today, because I know the exact moment that I'm going to sell all of my stocks, the moment that the meltdown will begin.
Are you saying that you think the melt-up is over?
Now, it may feel that way when you see digital artwork selling for $70 million and stocks going up despite the fact that there are supply chain shortages everywhere and that inflation is worse than at any point in the last 3 decades. It's hard to believe this can go on much longer. Now, most of the people that I talk with are in one of 2 scenarios. Either you've been sitting on the sidelines, mostly in cash, and you're wondering if it's too late to take advantage of this rally, or you've taken advantage of this unprecedented rally in stocks and your portfolio has never been better. But in that scenario, you're probably wondering if this is your last chance to pull your money out before the next big crash comes. You're also worried that if you do, you'll miss out on big gains if the market continues to melt up in 2022. After all, it's easy to be tempted to think that the market could do something similar over the next 12 months. And listen, I hope it will. But I bet you've felt that way in the past, and it didn't work out that way. Now, I don't believe you should sell your stocks just yet. In fact, I've found the exact thing that is going to make this stock market come crashing down, and today I'm going to show you a brand new timeline for when I think that could happen. This is a totally new prediction that I've never shared in a presentation like this before. But I also think that if you're investing in stocks and don't have an exit plan, you are playing a dangerous game. Because here's the thing, when the ultimate top in this market comes, it won't feel like a top. When it's time to sell, it's going to go against all of your instincts. It'll be the last thing that you want to do in that moment. Your instincts will tell you that things can get even better, that stocks can go even higher. Your instincts will tell you to hold on, that your portfolio will recover. But that's exactly what the top of a melt-up feels like. So I want everyone watching to take a good long look at themselves in the mirror and ask, how will I know when the meltdown has arrived? If you don't have an answer to that question, then I'm happy that you've tuned in, because that's exactly what I want to talk about today.
So Steve, what steps are you recommending everyone watching take?
Well, right now is the perfect time to think about important changes that you're going to make in the new year. I know most New Year's resolutions are tough to keep. Luckily, securing an exit plan for the coming meltdown isn't tough. It's easy. In fact, I've done the same. I know the exact moment that I plan to sell my stocks. And today I'm sharing how you can do the same. Figure the exact moment to sell your investments before the meltdown. And I truly believe that from among everything you might think about trying to do a little bit better in 2022, what I'm about to share with you will have the most profound impact on your life and your finances.
So Steve, is this a strategy that only works for subscribers, or is this something that anyone can do?
Nope, this isn't just for my subscribers. This is a strategy that can work for literally anyone. It doesn't matter at all what investments you own or what stocks you are currently holding in your portfolio. If you follow my work, that's great. But what I'm sharing with you today works on any portfolio of stocks, not just my own. So if you're watching this and you've never put a single dollar into any of my recommendations, I want to make sure that you know that this message is for you too. I'm worried that we've all gotten so used to stimulus money from the government that you may be thinking that stocks can only go up from here. But please, please, don't fool yourself by thinking that things will be different this time. The meltdown is coming and you need to be ready. I'm happy that I've heard from so many folks who've told me how much they've profited from my melt-up recommendations. Like Jim M., who told us recently, I have followed many of Steve's recommendations and my portfolio has increased over $400,000 in the last couple years. Raymond P., who emailed, hey Steve, I only invest in stocks that you recommend. I've made hundreds of thousands of dollars thanks to you. In this past year, I've made a load of green on Futu, up an astonishing 358% in a matter of a few months, plus 5 other recs all up triple digits. I know dozens of stock account managers, analysts, and advisors that secretly use your recommendations for their high-end clients with 8-digit account balances. And Dan S. told me, Steve, I at least wanted you to know that I appreciate the help you've given me increasing my retirement portfolio to $400K. I took much of my winnings and purchased a 30-year-old, well-run and profitable custom e-learning company whose owner was ready to spend time with his grandkids. But what would make me even happier is if I can help convince even just a few of you watching to make a New Year's resolution today that I know that you can keep. Because it isn't anything hard like exercising or eating better or quitting smoking, the kind of New Year's resolutions that people make and fail to keep all the time.
So what exactly is the strategy the folks watching should follow?
Well, it all started when I left school after earning my degree in finance. When I was in college, all the academics were teaching something called efficient markets theory. Basically, it's that it's impossible to beat the markets because asset prices reflect all of the available information. That's what they were teaching in higher education at the time. But once I got into the real world of finance, I realized that studying the world's best investors might be a better way to learn how to actually make money investing than listening to the theories of academics. So I began studying the best investors of the day, investors who were beating the market. I studied the writings of Paul Tudor Jones, Stanley Druckenmiller, Warren Buffett, George Soros, and the like. And I eventually found myself reading a book that changed my life and my investing approach forever. I'm talking, of course, about the book Market Wizards by Jack Sjuggarud. This book was the first window I had into the minds of the best investors in the world. That's because the book wasn't a how-to guide or a biography of how an investor had made his fortune. Market Wizards was so unique because it was a record of real question and answer interviews with the best traders in the world who talked about their thought processes, how they got into business, their trading styles, their decision-making processes, and the biggest market battles that they found themselves in. For the first time, I had a guidebook for how the best traders in the world thought about trading. And while I was familiar with some of the men interviewed in the book, like Paul Tudor Jones, the other investors were folks who I'd never heard of before because they shunned the spotlight so well. But what they all had in common is that they were simply hardworking professionals who managed the anxieties and uncertainties of trading by putting a system in place for cutting their losses. And that was the aha moment for me in my own career.
So your aha moment was that you needed an exit plan.
Right. So when I started my first newsletter, True Wealth, I realized that if I could come up with a simple way to cut my losses on my losers, I would dramatically increase my odds of beating the market. And one common way to do this is by using a stop loss. And for those who are unfamiliar with a stop loss, it's a simple concept. Say you buy a stock at $100. If you're using a 25% stop loss, that means you sell the stock if it falls below $75. Pretty simple, right? And this ensures that you never lose more than 25% of your original investment. But the problem with an ordinary stop loss is that it doesn't protect your gains. So when I started my True Wealth newsletter, my strategy was to use a 25% trailing stop on all of my positions. It's essentially a stop loss, but there's more flexibility built into a trailing stop because as a stock moves up, your trailing stop adjusts based on each new high, protecting your gains as the stock rises. So if you buy a stock at 100 and it rises to a high of 150, then your trailing stop would tell you to sell the stock when it fell below 112.50 or 25% below the stock's high of 150. In other words, as the stock you own moves up in price, so does your stop loss.
Let's take a look at how that worked out in the real world. Steve, you launched True Wealth in 2001. And as you mentioned, you used a 25% trailing stop to cut your losers short.
That's correct.
Now, let's take a look at this chart, which shows how your strategy worked as compared to the overall market. And as you can see, this strategy allowed your recommendations to beat the market by 20% over that time. Steve, that is not easy to do.
No, it isn't. But I could have done better with one small change to my strategy.
You could have done, what do you mean?
Well, the best way to show you is to add another line to the chart that you just showed. As you can see, There's another line on the chart now in green that shows how I would have done if I had used the 25% trailing stop across all of my positions.
Wait, Steve, I'm a little confused. You said that since launching True Wealth, you've always used a 25% trailing stop to cut your losses on your losers.
Right, which leads me to my second major aha moment as an investor. You see, I only used the trailing stop to cut my losers short, but for many years, I relied solely on myself for deciding when to sell my winners. And that resulted in one of two outcomes. I'd leave money on the table or I'd cut my winners short.
Can you explain what you mean by that, Steve?
Sure. One that comes to mind right away is when I recommended shares of Alibaba back in 2016. I recommended readers buy shares back in September that were trading around $102 a share because of the incredible growth I saw in China and the fact that Alibaba was smack in the middle of all of it.
And it turned out to be a great call.
It was. That was the right time to get in. But 2 years later, talk of a trade war with China started sending shares south. To be honest, I thought it would be temporary and that we should just ride out the volatility. But the trend down continued longer than I expected, and I eventually recommended my readers sell in November of 2018 for a 57% gain.
So there's nothing wrong with that.
Well, the problem is that I left a lot of money on the table. Take a look at this chart. As you can see, this is where we told readers to sell for a 57% gain. But had we simply used a 25% trailing stop on that position, we would have sold here, resulting in a gain of 106% for our readers, as opposed to the 57% gain that they actually saw. You see, I let my emotions get the better of me. I was so confident about the long-term prospects of the company that I didn't sell early enough. I was attached to the story. So we gave back a lot of the gains on that recommendation, and we didn't have to. That's what I mean about leaving a lot of money on the table.
So that's an example of how not having an exit strategy for your winners led you to wait too long before selling shares and gave up a lot of the gains that your readers had seen.
Correct. And importantly, the other consequence of not having an exit strategy for your winners is that you can cut your winners short. For example, back in 2003, everyone was buying real estate, and the demand for entry-level homes was skyrocketing. So I told readers of True Wealth that there was no better way to capitalize off the mania than buying one of the most popular home builders at the time, Beazer Homes. But about a year later, as rates were rising, the safest thing for my readers was to avoid stocks that traditionally get hurt when rates increase. So I recommend readers sell Beazer Homes for a 34% gain. I didn't want to give up too much of the gains that we'd seen. However, if I had simply used a 25% trailing stop to time our exit, instead of trying to time it myself, we would have done much better. As you can see from this chart, that single change would have turned our 34% gain into a gain of 154%, about 5 times higher.
And this was your second aha moment, that it's just as important to have a plan in place for when to exit your winning positions too, not just the losers.
Exactly. You see, what I realized was that I'd made a recommendation and then the stock would go up a lot and I'd sell it. But often the stock would go up a lot more. So I was giving up a lot of the gains because I wasn't using a trailing stop on my winners too.
Let's take a look at that chart of how this could have impacted the performance of True Wealth one more time. You're saying the black line shows the actual performance of True Wealth, which used a 25% trailing stop to cut all your losers short.
That's right, but I wasn't using the trailing stop on all of my winners too.
So you're saying that this line in green shows how you would have done if you'd simply used a 25% trailing stop on both your losers and your winners. And to be clear, this is using the exact same stocks you recommended on the exact same dates you recommended them. The only difference is that instead of using the date you recommended selling the stock, we're using a 25% trailing stop to tell us when to sell it.
Yes, and I think the chart speaks for itself. And by making that one small change to my approach, it would have allowed me to outperform the market by 40% instead of the 20% we actually achieved. But it's also important to understand why it would have made such a difference. Fidelity, as you know, is the largest brokerage firm in America. Not long ago, they looked at all the different portfolios managed by their clients to see which ones had performed the best. It turns out the best performing portfolio wasn't the smartest investor or the investor with the most experience. It wasn't the best value investor or the most forward-thinking growth investor, the day trader or the options trader. Would you believe that the top performing portfolios at Fidelity were portfolios of folks who forgot that they had an account at Fidelity? I know, it sounds crazy, but there's a simple reason for this. Our emotions get in the way, whether we notice it or not, and it causes us to make the same mistakes over and over again. If you can simply find a way to block your emotions from impacting your investment decisions, that alone will cause your performance to improve. Back when I started True Wealth, behavioral finance wasn't really a thing yet. But over the last 20 years, a great deal of research has been done on how your emotions can impact your results as an investor. And what the research